Hello everybody, hope you're having a fantastic day. It's been a little while since we did a video, but I was just in an all-day conference last Thursday and had some great information. I wanted to try to relay some of that information to you, our clients, and make sure that your expectations are in line with how we are actually investing your money. So you've probably heard me talk about this many times before, but the different dimensions of expected return. So for a dimension of expected return, for us to invest in it, it's got to be persistent, it's got to be explainable, and it's got to have worked over enough years that there's enough data to make it scientifically provable that there is higher expected return investing in that dimension. So these are the dimensions of expected return. Investing in the market versus investing in cash, essentially, T-bills. You have higher expected return by investing your money that way, in essence of about 5.5% compounded per year. Investing in small companies versus large companies, there is enough evidence to suggest you have a higher expected return investing in small versus large, about 3.5% compounded per year, which over time is a huge amount of money. Third, value versus growth, investing in companies that are trading at a discount relative to companies that are trading at a premium. Buying the cheaper company, you have higher expected return. And then investing in companies that are highly profitable relative to their peers versus not quite as profitable relative to their peers. All of these make perfect sense. I would expect to have a better return by putting my money in the market versus cash. More risk, higher expected return. I'd expect my money to have a higher return investing in small companies versus large. Meaning if I could buy McDonald's and I can buy Shake Shack, and they were both expecting the exact same return, then nobody would buy Shake Shack. Everyone would buy McDonald's. But if I buy the smaller company, I have higher expected rate of return. Value versus growth. If I'm buying a company that's cheaper relative to its book value, I should expect higher return. And then the last one obviously makes perfect sense. Now, you expect these premiums, these higher expected returns, to realize themselves every single day. So you're always invested with them. I wish I could predict when they realize themselves, but that's not possible. Nobody can do that. So you expect them every single day. But let's look at the likelihood that you are actually going to get those premiums over different time frames. So over any 1 year time frame, you can expect to achieve a better return investing in the market than cash 69% of the time. Small versus large, 57% of the time. Value versus growth, 61 and 69% of the time. High profitability versus low profitability. Now, all these, the odds are in your favor. So if you had to make a bet, every single time you're going to put your bet on the market, you're going to put your bet in small, value, and high profitability. Every time. Now, but that really, looking at small versus large, 43% of the time you're going to lose that bet. So the further we extend that out, the percentages increase drastically, from 69 to 95, all the way down to where high profitability versus low has never actually underperformed. So it's not this is why you also diversify. You don't just own small companies, and you don't just own value. You own some of both, so you can spread your risk and always achieve better return, at least on average. So this hopefully illustrates to you the risk of putting your money in the market and then looking at it 1 year. Now you may say, well, I don't have 15 years. Well, I would make the argument that even if you're 85 years old, you're not just liquidating everything and pulling it all out. You still want your money to last at least 10, 15 years down the road, and still the odds are in your favor by weighting towards those higher dimensions of expected return. So hopefully this helps you understand a little bit about how you can expect the return to come to you. If you have any questions, give us a call. We put some slides in this week's weekly report to help back up some of this data that you're welcome to look through, and we're always here to answer any questions. 770-984-2312.